Okay, Assalamualaikum again. Today we are going to do this question, group assignment B, which is the previous semester's group assignment. And our question that I have picked up is question 1, which is relating to our company, Balkan and Corin. So the first thing that you need to take note is to identify who is the parent and who is the subsidiary. So the year end of the company, can you tell me when is the year end? Is it 31st of December 2020 or is it 1st of January 2020? When is the year end on the
31st
report?
December 2020, madam.
Thank you so much. Okay, so make sure that you take note on this because for your information, at the bottom, if you can see at the bottom, you have the information on 1st of January. That was the day that you acquired all the ordinary shares, not all, some of it, of course, preference shares and debenture. So in this question, the parent company is Balkan because parent Balkan has acquired the shares in the subsidiary. Subsidiary is Corin. So all shares, not only the preference shares, but also the ordinary shares and the debentures were acquired according to the information given. So if you look here, these are the date of acquisition. So if that was the case, here is 1st of January 20, and this is the reporting date 31st of December 20. So here is where you acquired 1st of January 20, and what you acquire is ordinary shares, the preference shares in the subsidiary, as well as the debenture. So be careful in case there are 2 or 3 debentures or 2 or 3 preference shares in subsidiary. But here it was 6% preference shares and 8% debenture. So you need to find out what are the holding percentage or the controlling interest by the parent, the non-controlling interest, and for the debenture, what are the things belonging to the other debenture holder. So that one should be done on the first date. And you are informed the units of share capital in Corin was 937,500 units. So if you look here, the amount was also 937,500. So it means that the fair value of the shares was 1 ringgit because the units and the amount is the same. In case the units are different, so it shows that the fair value of the shares is not 1 ringgit. Let's say you have double the amount or half of the amount. Maybe it was 2 ringgit or perhaps 50 cent. It depends. And same goes for the preference shares, where you are also informed the preference shares also have the same units which are equal to the amount. Sometimes it may not be the same. So to conclude, what you have is that fair value for both ordinary and the 6% preference shares is 1 ringgit. Right. So you are informed the balances of the reserve account of Corin on the date of acquisition. So the date of acquisition is 1st of January 20. These are actually the pre-acquisition reserve balance, pre-acquisition reserve. And that was the balance on the date of acquisition, 1st of January 20. But bear in mind, for the retained profit, it can also be a net debit balance. So this one is a credit balance, so you will see that was retained profit. In case it is a debit balance, you may come across retained loss because there are a lot of situation where company is making losses rather than profit, especially with the heat of the so-called COVID-19 pandemic, with the natural disaster and so forth. So you need to consider that. That question may also come across retained loss. Okay, so you have done that. The information on the investment in the subsidiary is here. So these are the consideration transferred, 3 consideration transferred. So meaning that you need to go and calculate goodwill coming from ordinary shares, preference shares, and debenture. And the amount that was acquired is informed here. For the preference shares, 75,000. For the debentures, RM 40,000, and for the ordinary shares was 750,000. So if you have done that correctly, you will get the investment in ordinary shares would be 80%, non-controlling interest was 20%. Investment in 8% preference shares, the preference shares, that would be, sorry, 6% preference shares, this one, 6%. And that would be 50%. The NCI was also 50%. For the case of debenture, investment in debenture, you invest 40,000 RM 40,000 from the total carrying amount. So that gives you 1/3. So that was investment in 8% debenture, right? So there are no NCI, but you have the amount that were related to others is 2/3. So you have done that part, right? Now we look at the question. So what you need to do is you need to go and combine the asset liabilities, but you are not going to combine the investment in the subsidiary because this will be eliminated. You will combine inventories, account receivable, bill receivable, all these will be combined. But whatever intercompany loan, you will have to eliminate. So here you will see that one item here, there is a loan. So we are talking about what to combine later so that you are clear. So loan here, it was loaned by the parent company Balkan given to the subsidiary company Corindo. So this was actually intercompany transaction. So to the point of view of the parent, this was a current asset, but to the point of view of the subsidiary, this was a current liability. So this figure must be compared. So if you compare, you would see that there was a difference of 7,500. And that one is the thing that you have to eliminate. That was confirmed in information number 8. So you are informed that that 7,500, which is actually 45,000 minus 37,500, was due to the cash in transit. So this one is just to relate to items that you shouldn't include anymore in your consolidated statement of financial position. For the share capital, this will not be included. This will not be included because this will be eliminated since we acquire the ordinary and the preference shares. Same goes for the debenture. So we are only going to show the one of the parent plus the one of the subsidiary, but excluding the amount acquired by the parent. So we need to go and eliminate the 40,000 that were acquired by the parent. So we will just report the debenture, but debenture that will be reported would be after considering the elimination of the investment in debenture. For the retained profit and the general reserve, you need to use the schedule. So for the calculation of the retained profit later, you need to use the schedule to do that, and also to calculate what is the non-controlling interest. So all this we are going to use the schedule to come out with the amount at the end of the year schedule. Then you are also going to add the bills payable, brief preference dividend payable, and dividend payable, and at the same time eliminating if there is any intercompany transaction. So meaning to say that we need to show the aggregate of the amount of the parent with the one of the subsidiary, eliminating for any intercompany transaction, and recognizing the unrecognized transaction on the date of acquisition. Or if you need to go and do any adjustment to the fair value, that has to be recognized. Okay. Then with the first one, so you have the information on the retained profit and general reserve. This will be shown in the workings when you calculate the goodwill. You need to go and show this in the fair value of the net asset. But bear in mind, for the retained profit, there are adjustments for this particular question. So if you look at the information number 2, we are going to focus on information that will affect the calculation of goodwill. I'm going to ask a few questions and you have to answer to this. So you have that on the date of acquisition. Recall the date of acquisition is on 1st of January 20. These are the fair value, and these are the fair value also on the date of acquisition. You are informed these are the fair value, which is on the date of acquisition. Land has a fair value of 300,000. Plant and machinery has a fair value of 385, and investment property has a fair value of 180,000. So investment property are not a depreciable asset. So you are informed here. It used the fair value model. So if you can recall fair value model, there is no depreciation. For the land, this is also non-depreciable asset because land is not depreciable asset. So therefore, there are no adjustment for depreciation. For the plant and machinery here, that is some adjustment that you need to consider when you do your revaluation, where the depreciation must be reflected, which is using reducing balance method. So number one, the first thing to do is when you are informed the company has not incorporated the value of the asset, meaning that the fair value has not been incorporated yet. So what the parent need to do, Balkan will need to go and incorporate the new value. So Balkan has to go and show the asset, the three asset there at the fair value. To do that, some fair value adjustment must be done for land and the plant and machinery, but for the investment property, that is actually going to be adjusted to reflect the fair value model. For land and plant and machinery, it use revaluation model. For the investment property, it use fair value model. So can you tell me what is the value or the carrying value for the land on the same date, 1st of January 20. So for your information, if you can go to the question, the carrying value here for the land was 228. This is on 31st of December 2020. So this is on 31st of December. Can you tell me what is the value on 1st of January 2020? What are the carrying value of the land? Is it 228 or is it different? Is it going to be the same?
I think it's the same matter,
Why? Yeah, you are correct. But why is the same? Because land is not,
not depreciable.
yeah, it's not a depreciable asset. So for the land, the carrying value on 1st of January 2020 is still the same. Yeah, which is 228. So you cannot compare with the carrying value on 31st of December. You must compare with the one on 1st of January. So it is the same because there is no change to the carrying value of the land until the 1st of January here. So meaning that beginning of the year also it is the same. So meaning to say that here is 228. So if you compare that, you would see that there is a revaluation surplus. And that revaluation surplus will be how much? 72. Okay, we calculate that first. And then for the plant and machinery, it will be the same or will it be different for the plant and machinery? Will the value 1 year earlier means here, the same as the value here. So in your question, you are informed the carrying value of the plant and machinery on 31st of December 2020 was 436,500. 436,500. So the value here, which is on 1st January 20, the carrying value here, do you think is the same or will it be higher or lower?
Higher.
Higher, right? Okay, because earlier you will have depreciated slightly lower, so the carrying value will be higher. So the way you do it is you need to gross up this. It shouldn't be 436,500, but you need to add back the 10% depreciation to it to find out what are the carrying value 1 year earlier. So what you can do is, I'm going to show it here. Wait, yeah. The value would be, so if you look here, for the this one, can you look at this column here? So for the carrying value, as at 1st of January 2020, the carrying amount or the carrying value of the land is the same. But for the case of plant and machinery, P and M. I put there P and M, plant and machinery. Right? It would be 436,500 times 100 over 90. 100 over 90 because the depreciation was 10% per year. So if you want to know 1 year earlier, 100 over 90. But if you want to know 2 years earlier, it would be 100 over 90 and then one more 100 over 90. But if here you just want to know 1st of January 2020. Let's say you want to know 1st of January 2019, if let's say that is the one, so what would you do is, I've shown this in the YouTube video. I've shown all this. If you have, you have to go and check. So if it's for 2 years earlier, it will be 100 over 90 and do it twice. 100 over 90. So to get the carrying value. But in our case, it's just 1 year earlier. Why 1 year earlier? Since what you have here is acquired on 1 year earlier only. So you are trying to find out just 1 year backwards, right? So you're not trying to find like 2-3 years, just for 1 year. Let's say if the acquisition was 1st of January 2018, 2019, so the way you calculate will not be the same. But here it is just for 1 year only, will multiply by 100 over 91. So you have 485. Then you will compare with the fair value. The fair value was given in the question 385. So you have a deficit, which is an initial revaluation to be 100,000. Why deficit? Because the fair value is less than the carrying amount. So there was a deficit. For deficit, this is not to be offset against asset revaluation reserve of land, because this is plant and machinery. The one that has a surplus is the land itself. So what you need to do is you need to go and debit the retained profit, because deficit under MFRS 116 is debited to the retained profit. And the asset that was being revalued is Corin, the subsidiary. Corin, the subsidiary. And that will be credited to the plant and machinery. So that will reduce the plant and machinery by 100,000. But the thing happened on the date of acquisition. So the retained profit pre-acquisition figure will be reduced by 100,000. So when you do this, you are going to reflect that where? Here. You are going to reflect here in the calculation. It will be here. Retained profit before the adjustment, it was a credit balance 130. But when you do the revaluation deficit, you debit retained profit, so you reduce by 100,000. And you will see later that there will be one more, which is fair value gain on the change of IP. Before that, I am showing you the value for the consideration transferred. And the share capital, there was no change to calculate the goodwill. Share capital, there is no change. Why? Because there are no bonus issue. If you come across any bonus issue, you may need to go and do any adjustment here if you have any bonus issue by the subsidiary company. So let's look at the question for a while. Here is the question. So what you compare is you compare with 485. And here, this is not revaluation surplus. This is what you call fair value gain. And that was 100,000. So this is using revaluation model. This one is using fair value model. This is, I have to delete, that was wrongly explained. Let me just do it correctly. This one is revaluation deficit. Sorry. This one is revaluation deficit. I was thinking that this is for the deficit for the property. So you can compare 100,000 deficit. So that 100,000 deficit is where I debit just now here. So here is where I debit. You can see here 100,000. And when you debit, you reduce the retained profit, and that will also be reflected later in the soft P. Apart from doing that, you also need to do the adjustment for the over provision of depreciation. OPD is over provision of depreciation, because for the surplus, you will have under provision. But for land, there is no adjustment for depreciation because non-depreciable asset. However, for the plant and machinery, since you have 100,000 here, you need to go and adjust depreciation 10% on reducing balance method. And when you do that, you will need to go and reduce the depreciation. So if you increase the depreciation, you go and debit retained profit because it is an expense. But here you reduce the depreciation because it was being over provided. So you decrease it, you go and credit the retained profit by 10,000. So this must be reflected in the schedule. So this will be reflected in the schedule. But this one will be reflected where? In the C, in your soft P later. Right. But this part, the one that you have here, this will be in the soft P. But the one here will be reflected in the workings for fair value of net asset. So you're going to see this here, and I'm going to show you together with the land as well. So let me just show you this here. One item. For general reserve, no change. You just take the pre-acquisition balance. For the land, just now remember fair value of the land was 300,000. And the carrying value was 228, so 72. So what I'm trying to tell you is that this deficit of plant and machinery shouldn't be offset against 72,000. You cannot do that because this one is actually a different asset. So now we go on to the third asset, which is also being fair valued, and that was investment property. So let us look at investment property. So under investment property, if you can still recall, do you need to provide depreciation for fair value model?
No.
No. If it's a cost model,
Yes.
yes, but this one is fair value model. So if it's a fair value model, no depreciation. So meaning that this is similar to the case of land. So you just straight away go to the investment property, look at how much. Oh, that was 117, fine. So you take that 117 and put and you will compare the carrying value on that date, 117. And if you do that, you'll get 63. So that's 63,000. 63, yeah? 63 here is actually your fair value gain. Fair value gain, it is not in the ARR. Fair value gain, you will debit investment property and you will credit fair value gain, which is actually in the retained profit. So the difference is how much? 63. How do you get 63? 180, the fair value greater than the carrying value. So the fair value change is a gain. So this must be incorporated, but this will be adjusted in the on the date of acquisition. So when you adjust in the date of somewhere on the date of acquisition, it will be here. First, you need to go and show it, and you reduce that here. Fair value gain. I use purple just now, so I use purple here, 63. But in terms of the adjustment, it is I have put it here. So for the investment property under fair value model, you will see that this figure that you have here is 117. I just leave it as red. 117 here, 117, and you will compare with the figure of fair value on the date of acquisition, 180 fair value gain. So the journal entry will be debit IP. So this one will be reflected in the C soft P later. You need to go and add. And when you go and credit the retained profit, this will affect your fair value of net asset. So this must be adjusted where in Corin. Corin retained profit. So Corin retained profit. 63. So when you do that, it will be adjusted here. So therefore, the figure here would be 93. How? 130 minus deficit plus fair value gain. So you have 93. And now you can find out your fair value of the net asset. And your fair value of net asset would be 1,147,500. And you are informed on the measurement of non-controlling interest. So you are done with this, right? And we have to go and look at the just some information on non-controlling interest here. You are informed that it is measured based on the proportionate share of the fair value of the net asset on the date of acquisition. So you know the non-controlling interest percentage was 25%, and the fair value of net asset you just calculated that was 1,147,500, and therefore what you have here would be um, it would be 1,147,500 multiplied by 20%, and that would give you 229,500. So that was the non-controlling interest on the date of acquisition. Do not forget to show this where in the schedule later. So if you have done this, you can put them in the schedule, but we're trying to calculate the goodwill. So the first goodwill was from the acquisition of ordinary shares 207, right? Now you're going to calculate the second one, which is the goodwill for preference shares. The consideration transferred was given here. This figure, 75. Just now we used this. So 75, the one for debenture was 40,000. Make use of that. So I'm putting one for debenture here. Right. Now you are going to find out what is the non-controlling interest. Non-controlling interest will be 50% from 150,000. This 150,000 is the carrying value. Carrying value of your preference shares, which is this carrying value, 150,000. So take that, multiply by 50% non-controlling interest. Then you will have to compare with the preference shares in the subsidiary. That was also 150, and that gives no goodwill again. No more, no goodwill. So there is no goodwill. The goodwill is zero. Do you have any questions so far?
So far, no question, madam.
No question.
So
Okay.
for okay, madam.
Any other thing apart from question? Any clarification that you need me to explain? Any part? Because we are going to move on to debenture. So for debenture, there is no NCI, but you need to go and compare with the carrying value that you acquired. Earlier, you acquired one third. So one third of 120,000, one third from 120. So take that, one third from 120, that becomes 40,000. So there is no NCI, as I said. So therefore, the goodwill is none, no goodwill. So the total goodwill coming from the three items there is 207. So coming from here, here, and here. And if you look, there was an information regarding the impairment of goodwill. So here you have the information on goodwill. So the 15% that was impaired is 15% times 207, which is the total goodwill. So if you do that, the impairment would be 31050. Yeah, and this is where you will debit group retained profit and you will credit the goodwill on consolidation 310.5, 310.5. So that one will be shown in your schedule later, but I'm going to show it now. So after you have done that, so you can do the journal entry. That was the requirement of the question. These are the requirement to do the journal. So the first journal is the one that relates to the ordinary share. So what you have here is actually from here, from this working. So this 937 is what you debit, 93 is what you debit, the general reserve is what you debit, yeah, and the ARR of land is what you debit, because all these must be eliminated on the day of acquisition since the control was acquired. And what you would credit is the non-controlling interest. And don't forget to also debit the goodwill. So here is the working. right? So the total investment in orange share capital was 1125. If let's say you have acquisition from or a preference shares that also has a goodwill, do that separately. Or maybe you have acquisition that has a bargain purchase, do one more separately. Do not put the acquisition or the goodwill of a different types of financial instruments in the same journal. Do them separately. So here you can see that for just doing your 10 your journal entry, you get 10 marks. Just doing this, you get 10 marks. You do the calculation, you have 10 marks. So now you are secured with already 20 marks for this particular part only. Okay. Do you have any question so far? Class?
So far, no question, madam.
Not yet, yeah? Okay. Let's go back to the question. So you have a few more things to do, which is number 3, number 4, number 5, number 6. Before we do that, let's look at the schedule. So first you will have to write show again the non-controlling interest. So what you can see here in this schedule, I put the non-controlling interest column right to the adjustment. That does not matter. You can put it right first, you can put it in the middle, you can put it in the last column. That does not matter. What matters is you have all those columns correctly shown. It does not matter the order. So here the first item, the first one would be the non-controlling interest on the acquisition of ordinary shares, which is this one, 229,500. And the second one would be this, the one here, which is 75. So 75 non-controlling interest and one more non-controlling interest here. Put it here. Next is to show the retained profit of Corinne that relates to the adjustment on the date of acquisition. So beginning balance of retained profit in Corinne before the adjustment, retained profit carried forward from the question. Corinne, yeah, look at Corinne column here. You have 740,000, sorry, 240 and 510. So this one is of Corinne, this one is of Balkan. This one is of Corin as well. For the general reserve, this one is of Balkan. So you can show that first. So 240, right? I have put all the adjustment during the pre-acquisition period. Revaluation deficit, debit, retained profit. So we show here, credit, the revaluation deficit here is the one that you go and credit to the, what was it just now? Plant and machinery. Okay. Then your fair value gain, this is the one that you go and adjust to the IP, IP. And the first one was on plant and machinery. So here, the adjustment I've done it earlier. And the next one is the pre-acquisition balance. Pre-acquisition balance is the one that you have in your is working. This one 93 here. That 93 is the one here and also the one here. Okay. Then you have your adjusted pre-acquisition balance. So now what we're going to do is I'm going to show you the one of Balkan. So for Balkan, just put the balance first. Put the one for general reserve of Balkan as well. That is directly from the retained profit, from the carried forward figure. So we put here carried forward. This is also carried forward balance before adjustment. Right? Same goes here, carried forward. Here also, carried forward. So just do what you know first, do it right, include there. Now let us go and do the rest, which are the remaining adjustment. Before that, you have an over provision of depreciation much earlier. Remember when you were doing the revaluation deficit, there was an over provision. This one here, this one, and 10,000 credit retained profit of Corin. That will be during the post acquisition period, so it will be 10. So 10 here, so put it here. Now we will be doing the rest of the adjustment, which is the one that you have there. You're going to answer me when I ask, inshallah. Right. So the first one here. First one, yeah? Am I still around there? Am I still connected to you?
Yes,
Yes,
madam.
madam. Still
Okay.
here.
Okay, Balkan. Who is the seller here? Balkan bought a motor vehicle 480,000, right? Balkan bought, this is the selling price, from Corin on 1st of April 2020. So this is during the current year. And it was bought from Corin. Who is the seller? Is it Balkan or is it Corin?
Corin.
Corin. Okay, so Corin is the seller. Do you know why I asked you the question? It is because if there is a provision for unrealized profit adjustment that you need to make, you need to go and adjust in the retained profit of the seller. So seller is Corin. So here there was a profit that has been made by Corin when the motor vehicle was sold between group member of 20,000. However, that profit shouldn't be realized. The reason is because this is intercompany transaction. So for the profit that earlier has been recognized by Corin, you now need to make some adjustment. You need to go and remove that unrealized profit. Who is the seller? Corin. So what you will do is you will debit retained profit of Corin. I put C for Corin, 20, and you will credit the motor vehicle. The buyer here is Balkan B20. But that is not enough. You need to do another adjustment, which is the adjustment related to the depreciation. So here you are informed the depreciation depreciation was having a remaining useful life of 4 years. So the remaining useful life of 4 years, so what you need to do is you need to go and adjust for the depreciation. So if you have a profit, this will lead to an over provision. So if you in case have a loss, this will lead to an under provision of depreciation. So just remember, for profit, over provision. So if it's a loss, it will be an under provision. Ours is a profit, so it will be an over provision. When an over provision means you need to go and reduce your retained profit. Of whom? Again, the seller. So Corin is the seller. So remember, that's why I'm asking you who is the seller, Corin, yeah? So you need to go and reduce the depreciation because depreciation has been over provided. So debit against the motor vehicle of Balkan. The adjustment would be just take the profit, 20, divided by 5 years, multiply by 1 because only for 1 year. So look at the date, that was 1st of April. So let's say if you have done the transaction after the date of acquisition, but during the prior year, you may have to adjust differently. Go and watch the video that I've put on this over the YouTube. Go and check that because I've shown also what happened if the acquisition is already taking place more than a year. So here would be 20 divided by 4 years, 4 years remaining useful life, so it will be 5 and 5. And this will affect your schedule. So when that would affect your schedule, you are going to show that here. Whose schedule? The one of Corin or the one of Balkan? Who's retained profit?
Corinne,
Corin. Why? Because Corin is the
seller.
Yes, very good. Okay, Corin is the seller. So you can see that the unrealized profit was being removed because our journal entry just now debit retained profit of Corin, right? So that means we need to remove. And our journal entry one more is credit retained profit of Corin with the over provision. So that is to be added to the retained profit of Corin. And the target is to find what is the post-acquisition profit that will later be shared by the parent and by the non-controlling interest. So that was the first one. I will do the CSOP later. I'm just do the workings first. Next is number 4 is done. So now we do number 5. So for number 5, this was on upstream sale. So when I say upstream sale, you should be able to straight away understand that this one is the case where Corinne, the subsidiary, is the seller. So whenever you have an upstream sale, it is where the subsidiary is the seller, the parent is the buyer. However, if you have a downstream sale, it's the case where subsidiary is the buyer and the parent will be the seller. Here you are informed Corinne is the one that has invoiced goods of 30,000. So these are intercompany sales to the point of view of Corinne, but it was an intercompany purchase to the point of view of Balkan, because that are about inventories that are being sold off between group member. And the subsidiary, which is the seller, who is the seller? Corinne, right?
Corin.
Corinne.
Yes.
Okay, so Corinne has charged 8250 on that sale. And it is discovered that half of the good was still unsold. So meaning that the sale does not really take place to outsider. It was just between group member. So there is a need for you to go and eliminate the unrealized profit. And the unrealized profit would be 8250 times 50%. 50% here is the unsold percentage. So this one will give you 4125. So if you take, you will to remove debit retained profit of Corinne, C, credit the inventory of Balkan 4125. Is that all? No, you have one more, which is this last sentence. Balkan has not made any payment related to the purchase. So meaning that when Corinne sold the goods, the subsidiary is the seller, but the account receivable is the parent company. So parent company, when they bought the goods, the accounts payable or the supplier that are dealing with is the subsidiary company. So that gives rise to an accounts payable and accounts receivable. So therefore, and that amount has not been the payment has not been made because Balkan has not made any payment, not half, but not quarter, but all 100% out of 30,000. Some question you may come across. Balkan has not made payment to the 30% of the goods sold. So you know that the 30% is the payment that were not yet settled, but here has not made any payment. None was made, so that would be adjusted in the accounts payable and will be adjusted in the accounts receivable, right? So payable of Corinne, account receivable of who is this? Balkan. How much will be 30? 30. But this one would not affect the schedule. This would affect what? The C soft P. But the one that would affect the schedule, I've shown you already. So let me show you again for the unrealized profit. But this time it's not for motor vehicle, but this is for the goods sold. Okay, these are the unrealized profit for the unsold. And some question will give you profit in the being expressed as markup or margin. Margin is on sales. Markup is we are talking about cost plus. Let's say 20% markup. It means 20 over 120. If you come across profit expressed in margin, let's say 30%, that is 30% based on sale. So you should be able to understand that because those are things from your management accounting costing study, right? Done with that? Now we look at number 5. Number 5 is item that does not affect the schedule. It's about the intercompany bills where you have bills payable of Corinne. Bills payable of Corinne 40,000 and Corinne has factored to 20,000 of the bill. So if you can recall, there was the journal entry for the undiscounted bills. So in our case, the undiscounted bill is 40,000 minus 20,000. So the undiscounted bill is 20,000. So what you need to do is you need to go and eliminate the discounted bills or undiscounted bill. Which one do we eliminate to report that in the consolidated statement of financial position? Do we eliminate undiscounted bills or do we eliminate the discounted bills? Class.
Undiscounted bills.
Okay, undiscounted bill. So debit bills payable to remove the undiscounted bill of Corinne. Credit bills receivable. Here is the receivable of Balkan. That will be 20,000. So that will be reflected not in the schedule, but will be reflected in the um, consolidated statement of financial position. So we have now two more items, actually three, but you look like it is still a two. This is regarding dividend. 7 and 8, and also one more in the few more things which are here. Here, also regarding dividends. Yeah, these are all regarding dividends. So these are all things that you need to also go and do consolidation adjustment. Let's look at what was given first so that you can identify which belongs to which. Okay, number 6. You are informed Balkan. Who is Balkan? Parent or subsidiary?
Parent.
Parent.
Okay, parent, you know Balkan is the parent company. Parent has not recorded dividend income on preference shares from Corinne. Corinne is the subsidiary. So subsidiary has recorded the preference dividend. How do I know? If you can see here, preference dividend payable 9,000. This is by the subsidiary company, right? So subsidiary has recorded that 9,000. Do you know or not that 9,000 is actually 6% times 150? Which is this 150 times this 6%. So that was the dividend that has been declared by the subsidiary. However, you are informed very clearly in the question that the parent, which is Balkan, has not recorded the dividend. How, even if let's say this was not informed, you should be able to tell how. If you go to the statement of profit or of financial position, you will see that there is no information on preference dividend receivable here. That shows that the parent has recorded the dividend. No information. So this is situation 1, situation 2, or situation 3. There are 3 situations. Situation 1, both parent and subsidiary have recorded the dividend. Is this the case? Yes or no? Both have recorded. No. So this is
No.
not number 1. This is not number 1. Number 2. Number 2 is situation where both have not recorded. The first one is both. The first one is both have recorded. Second one is both have not recorded. So here parent has not recorded, but subsidiary has recorded. So is it situation 2? Situation 2, both have not recorded.
No.
No. No, right? Why? Because
No.
this is situation 3 actually. Situation 3 is where parent subsidiary has recorded. You go and check your textbook, go and check the notes, go and check the video regarding situation 3 where subsidiary has recorded but the parent has not. So subsidiary has recorded. How do you know? Subsidiary has recorded because the preference dividend payable has already been shown as 9,000 here. But you know parent has not, since the question tells you. When parent has not recorded, you will record. So how you record? You will take the one from the subsidiary only dividend payable. I put here ODP. I put here Corinne, meaning that under Corinne. Sorry, PDP. PDP is what? Preference dividend payable. So I take this 9,000 under Corinne. And what should be done is that parent shall take the share. You acquire 50%, right, in the subsidiaries preference share. So 4,500 will need to be removed from the preference dividend that will be shared by the parent. So retained profit of the parent, Balkan, or this is actually GRP group retained profit, 4,500. So this will affect the C's of P, but this will affect the schedule. So this is situation 3. Okay, situation 3. So that was situation 3. Let us look at the impact here. So for situation 3, it will not show the item in the retained profit of the subsidiary, but it will be in the parent. So it would be here. Preference dividend receivable 50% from 9,000, because you have the share of 50% in the preference dividend. And do not forget about this item, satu item yang ni, this one, which is, wait, yeah. Do not forget about the impairment loss. So impairment loss that we impaired earlier, remember? 310550. So there are already 2 entries here. Right. So this is situation number 1, 2 or 3. This is situation 3. So let's look at number 7. Number 7. Class, are you there?
Yes,
Yes,
madam.
madam.
Am I
Since
speaking
here.
to you? Okay, good. Next, we use a different color. We use blue. Okay. So this one number 7. Number 7 is where you are informed both company have not yet provided for the debenture, for the preference dividend, situation 3. But this is for debenture interest. So debenture interest, both company have not yet provided. Situation 1, situation 2 or situation 3?
2.
2, correct. Because both company have not recorded. So situation 2. So what you need to do is first do for the subsidiary first. So record for the subsidiary what has not been recorded. So if you can see here, go to the question, check the question. You have this is the subsidiary, debenture, and this is the interest. This is the parent debenture, and this is also the interest rate. So let's do for the subsidiary first. For the 120,000, first we record for the subsidiary for 1 whole year. So what I will do is I will debit retained profit of Corin, the subsidiary. Yeah. And I will credit debenture interest payable of Corin. DIP, debenture interest payable. So that would be 8% from, what was the figure just now? What is the figure? 120,000. 120 times 1 year. So this will be 9,600, 9,600. So subsidiary has not provided. And when subsidiary declare the debenture interest, parent will have the share or not in the debenture interest? Can you answer me?
Yes.
Yes. Why? Because parent acquire 1/3 of the debenture. So this is number 1. So number 2 is you will record the share of the parent. So debit debenture interest payable of the subsidiary 8%, and that would be 9,600 multiplied by 1/3. 1/3 is the portion acquired by the parent, and if you do that, you will get, how much will that be? 3,200, right? 3,200, because 1/3, right? 3,200, and that will be credited to the group retained profit, or this is actually retained profit of Balkan, 3,200. So this will affect the schedule. Yeah, this also will affect the schedule. But this one you will deduct, this one you will add. And don't forget that the parent itself also has the debenture that was being issued here, 417, 8%. So that one is the debenture that the parent itself declared the debenture interest, because it says both. So number 3 is debit debenture interest payable, Balkan, credit the group retain profit or retain profit of Balkan. How much? 417 times 8% times 1 year. So if you do that, you will get 33. Go and take your calculator, 33,360. And this one will have to be, sorry, it was the other way around. Let me just correct it. I have done it wrongly here. Let me just correct the working here. It will be like this. Just make sure you take the correct one. Debit group retain profit or the retained profit of Balkan, 33,360, and credit debenture interest payable. So I got it reversed, but it should be like this. Debenture interest payable, Balkan, 33,360. So this is an expense. This one was an income, but this one was an expense. So this reduce the profit, reduce the profit. But this one increases the profit because it's an income, but this one reduce the profit of the subsidiary. So let's see the effect of that. Two items, number 6 and number 7 here. Okay. Debenture interest payable by the subsidiary, 9,006. The one shared by the parent in the subsidiary, 3,002. The one declared by the parent itself, 33,360. 33,360. There was an expense. This one was an income. But this is income from subsidiary, but it will be eliminated in the consolidated statement of financial position. There is one more. Ada lagi satu. Come, let us look at what is that. Here, this one. Look at ordinary dividend receivable and the ordinary dividend payable. Let me just highlight this so that you can see things better. This one, ordinary dividend payable. Look at the color that I use. The yellow, 75,000 declared by the subsidiary. And you see here, ordinary dividend 60,000 that was received by the parent. Do you know or not this 60,000 is actually 75,000 times 80%. Take your calculator, 75,000, which is this figure. 80% is the percentage acquired by the parent. This is the percentage of holding in the ordinary shares. Do you get 60,000 there?
Yes.
Get 6.
Okay. What is this situation of dividend? Situation 1, situation 2, or situation 3?
1.
1. Why? Both have recorded. Subsidiary has already recorded the dividend as by declaring it the dividend and show them as current liability. Parent also has taken credit of the share, take the share of dividend, which is 80% from 75,000, the one that was in the subsidiary. 75,000. So it means that you need to go and eliminate this 60,000. This 60,000 shouldn't be reported in the consolidated statement of financial position as part of the current asset. And that 60,000 also must be removed here in the dividend declared by the subsidiary because this is intercompany transaction. So first there are no adjustment here, nothing. So we are done. But that will be done how? It will be done here. I just do it here. Debit ordinary dividend payable 60,000. This is the one under Corin. Credit ordinary dividend receivable under Balkan 60,000. So this must be done. in the adjustment to reflect this, to reflect the 60,000 here. Right, so let's look at the rest of the entry. So you are done. So when you are done for the parent, for the subsidiary, yeah, you need to show what is the portion of the post-acquisition profit that belongs to the non-controlling interest, and that was 91,275 times 20%, and this one is 91,275 times 80%. So this is the group retained profit column. This is the group general reserve column. This is the non-controlling interest column. I'm just showing the workings for this. Next is the one of the parent. The profit of the parent, the post-acquisition profit of the group now would be 453,290 after deducting the impairment loss. General reserve of Belcan, no changes. When there is no changes, is, let's say if there are changes, maybe bonus issue done by Belcan itself, debit general reserve credit on share capital, you need to go and reflect here. For the general reserve of Corin, also no changes. Only that you need to go and reduce with the pre-acquisition general reserve balance. Where do we get this 45,000? This 45,000 is from here. Yeah, the pre-acquisition reserve. 130 is also shown in the schedule. Right, 130 is here. We have done that earlier. So I'm just focusing on general reserve. So 30, the portion shared by the non-controlling interest is 20% from 30,000. The portion declared or shared by the group is 24,000, which is 80% times 30. So the total here would be 328,755 non-controlling interest, 526,310 group retained profit, 268,500. So let's look at what you have here. The first one, land at the one of the holding plus the one of the subsidiary and add the revaluation surplus that arise on the date of acquisition. Do you have question before I proceed?
No, madam.
So okay, madam.
You're not becoming, are you sleeping, brother John? No, right? Okay,
Not yet,
second.
madam.
Okay, second one is plant and machinery. Just add this. Do you know or not? By just doing what is in the bracket here, you got one tick already. So don't get so worried of the adjustment if you do not know. Go and do the simple one first. Do the one in bracket first. Here, revaluation deficit 100 over provision of depreciation. Remember we did earlier in the journal, small journal that I did. And then there's one more, plant and machinery and investment property here. Okay, for investment property, that was fair value gain, no adjustment for depreciation. Motor vehicle, there was unrealized profit due to the intercompany sale of motor vehicle and over provision. So you can see the workings are given, marks are given for each of the item here. So make sure you show. For the goodwill, you need to go and remove with the impairment loss. The total goodwill, yeah, Kirisha, total goodwill. Then current asset, inventory, just remove the unrealized profit. This one, account receivable, remove the intercompany amount owing, the journal entry I did earlier to show the elimination of the amount or the balances of intercompany. Then next one is the item related to cash in transit and bank. Bank is the bank balance. Just add them, no adjustment there. For cash in transit, it arises because of the difference in the loan or intercompany loan to versus intercompany loan from. The difference was 7,005. So I've done that earlier. Right? If you want to see the journal entry, we can do it here. Where is it? This one? Debit cash in transit, debit loan, and that is we need to go and check whether loan, okay, loan from, credit loan to, loan from 37. Look at the question. 37,500. Okay, here is 7,500. 7,500. Here is 45. So that would affect the cash in transit. In this is going to be shown in the Shopee here. And the last row in the asset was ordinary dividend receivable. Remember earlier it was 60. You eliminate the intercompany dividend. This is what? Income from subsidiary. Even if there is no figure, there are marks allocated for this. So do not just leave it without showing the working. Make sure you show the workings for the ordinary dividend receivable before it becomes zero. There is marks even for this. There are one tick given here. And there are tick given just to show you. Right. So if you don't show, you won't get, but you must have the item. Equity. For the ordinary shares, just the one of the parent, one of the parent. These are the one that you get from the schedule. Non-controlling interest, group retained profit, and group general reserve. Non-current liability is the one of the subsidiary plus the one of the parent and eliminating the acquired portion of the debenture by the parent. Current liability. Accounts payable, eliminate the amount owing. Bills payable, eliminate the intercompany undiscounted bills. Class, are you there? Because you are so silent.
Yes,
Yes,
madam.
Yes,
madam.
madam. Still here,
Yes,
madam.
madam.
Still here. No one is sleeping and realizing that sleeping on top of the laptop and with your
Not yet,
face
madam.
downward. Or dividend payable, the one you can also split this, meaning that you can have two rows for dividend, one for Balkan, one for Corin. You can do that, or you can just have one column like this, or just one row, 135, or you can split between what belongs to Balkan, 120, what belongs to Corin to be 15 only. Why 15? For the one related to Corin, just to show you certain things here. So you have 75 of Corin and the intercompany dividend was 60. So if you take 75 minus 60, 15. 15 plus 120, you have 135. Or you can show split row 120 for the parent, another 15 for the subsidiary. Both are right. But if you want to show one row like this, make sure all workings are shown. Preference dividend is also the same case. Okay, the one of the subsidiary was 9,000. The one shared by the parent was 4.5. So the one paid by the subsidiary to the non-controlling interest is 4.5. 9 minus 4.5. The one paid by the parent itself is 45. The last row here is the debenture, interest payable. So you can see that the intercompany debenture interest was being removed. Oopsie daisy. We just do that properly here. Yep. So you can see that this color that I use is showing the income from subsidiary. Okay, done. Yeah. Done. With that, I thank you for watching, for paying your attention. I hope that will help with the understanding because I am going to stop the recording now.